Lock your screen, turn off notifications, eliminate all distractions, because what happened last night was not just volatility, it was a controlled demolition that took place while America slept. Today is Friday, January 30th, 2026, and the market data tells a story that the financial press cannot honestly explain. Silver is trading around $98.46. Gold is at $5,025.10 levels. These figures are not just prices, they are fingerprints at a liquidation site. In a single night's operation, silver was pushed below that psychological threshold everyone thought was the bottom, and portfolios were wiped out in minutes by forces most individual investors don't even track. What made this massacre so ruthless was that it did not happen during peak hours when cameras were rolling and headlines were being made. It occurred during the Asian session, known as the dead zone, where liquidity dries up, stop orders pile up, and leverage turns into a guillotine. Silver did not fall gently. It tumbled from around 118.58 to 95.18 in a sudden drop. During hours when many accounts were unattended and brokerage risk algorithms were in play, a nearly 20% collapse occurred. Gold followed suit sharply because this wasn't just a silver story. It was a dollar story. And here's the first twist most people missed. Those prices you watched yesterday, the recovery, the bounce, and that false sense of security, were actually bait. The real battle is elsewhere, on another screen. Before we go deeper, do me a favor. If you want more breakdowns like this, hit like and subscribe. Because this channel doesn't chase headlines. We chase the machinery behind them, the mechanics that move price when narratives fail. Now let's open the hood. Gold and silver are priced in dollars. That sounds obvious, but it's the key to the trap. When the dollar strengthens against other major currencies, it takes fewer dollars to buy the same ounce of metal. That doesn't feel like sentiment. It functions like gravity. Picture a seesaw, dollar strength on one side, precious metals on the other. When the dollar rises, metals fall. When the dollar weakens, metals surge. This is an acute correlation you mentioned in a textbook. In moments like last night, it becomes mechanical causation. DXY tracks the dollar against a basket of major currencies: euro, yen, pound, Canadian dollar, Swedish krona, Swiss franc. When those weaken relative to the dollar, DXY climbs. And when DXY climbs fast, metals don't get a polite memo. They get a forced liquidation. That's because institutional desks don't trade the way retail does. They don't stare at silver candles and feel it out. They run models. They watch thresholds. They wire DXY movement into automated triggers. When the dollar index spikes beyond certain levels, selling programs light up in metals, stop losses trip, margin requirements bite, and the cascade feeds itself. So if you went to bed thinking $100 was a floor, your mistake wasn't optimism. It was looking at the wrong leading indicator. The crash didn't start in silver. It started in the dollar, then spread like a contagion through leverage. Now ask the real question. Why did the dollar spike while New York was quiet? Because the dollar doesn't need Wall Street's permission to move. It moves where the fear is, where the yields are, where capital feels safest. And right now, three forces are pushing the dollar higher at the exact same time. First, the Federal Reserve's posture. When the market believes rates stay elevated, dollar assets become more attractive. Higher yields pull foreign capital in, and foreign capital has to buy dollars first. That's not a slogan, it's a flow. And flows move markets harder than opinions. Second, risk aversion. In global stress, money stampedes toward the reserve currency. It's not because the world loves the dollar, it's because the world knows the plumbing is built around it. When geopolitical tension rises, when uncertainty spikes, when traders smell instability, they rush into dollars for safety, and the DXY rises like a pressure gauge. Third, China's demand signal. Silver is not only a monetary metal, it's an industrial one. When Chinese data disappoints, the market reads it as softer industrial demand. That doesn't just pressure silver, it can strengthen the dollar because money rotates out of perceived weakness and into the US complex. Stack those three forces together and you get an overnight sledgehammer, hawkish rate expectations, fear-driven safety flows, and demand uncertainty. That's how the dollar weaponizes, and when it does, silver doesn't debate. Silver obeys. This is why the overnight session is where retail gets harvested. When liquidity is thinner, the same dollar move creates a bigger metal move. Stops become targets. Leverage becomes fuel. And the market doesn't need to decide to punish you. The risk engines do it automatically. Now we need to talk about the trap inside the trap. Leverage. Because the overnight massacre didn't just lower prices, it selectively destroyed a specific kind of participant. If you held physical metal, you felt pain. If you held unlevered exposure, you took a hit. But if you held leverage, margin, short-dated calls, oversized futures, last night wasn't a drawdown. It was an extinction event. Leverage magnifies everything. With 5-to-1 leverage, a 2% move becomes 10% in your account. That sounds thrilling on green days, but the market doesn't only move 2% anymore. When silver drops nearly 20% in a session, 5-to-1 leverage doesn't leave you down. It leaves you gone. Your broker doesn't ask how you feel about it. Your position is liquidated to protect their capital. And the most brutal part is this: you don't even get to choose. The liquidation happens while you sleep, at the worst possible moment, in the deepest part of the wick. Then price bounces, and you're no longer in the trade. Your capital becomes someone else's entry. So here's the question I want you to sit with, because it's bigger than silver and it's bigger than this week. If the market's most violent moves are increasingly happening in the off hours, when liquidity is thinner, algorithms are faster, and your decision-making is offline, what does personal risk management even mean anymore? Are you trading a market, or are you volunteering as exit liquidity for machines that never sleep? And if that's the reality, how should a rational person structure exposure so they can survive the whipsaws without being forced out at the bottom? Drop your answer in the comments, because how you think about that question will decide whether you're still standing after the next overnight wave. Now, zoom out. The overnight crash felt like a verdict, but it was actually a test. Every bull market has moments like this: violent shakeouts that punish weak structure, not necessarily weak thesis. The long-term case for silver doesn't vanish because DXY spikes for a night. Industrial demand is real. Supply constraints are real. The geopolitical fragmentation that pushes nations to diversify reserves is real. What changed overnight wasn't the multi-year story. What changed was the short-term dollar impulse, and dollar impulses can be savage. But there's a calendar trigger sitting right in front of you. February 1st, 2026, the US government shutdown deadline. That date matters because it can amplify risk aversion and push the dollar higher in the immediate window, even if the longer-term political dysfunction narrative later undermines confidence. Markets often move in two acts. The first act is fear, the second act is interpretation. If fear dominates first, metals can take another hit. If interpretation flips, if traders read dysfunction as a crack in credibility, then the dollar can roll over and metals can ignite. So what do you watch now when the noise is loud and the stakes are real? You watch the leading indicator that front-runs your metal chart, DXY. You watch yields and Fed language because they feed dollar strength. You watch risk headlines because they redirect capital flows. And you stop pretending that a clean line like $100 support is protection in a world where the real battles happen overnight. This wasn't the end of the silver story. It was a transfer event, away from fragile leverage toward patient structure. The dollar is the weapon. DXY is the trigger, and February is the battlefield. The only question is whether you'll watch the right screen before the next shot fires.